All right, let's go over some other details regarding bonds. Let's look at credit ratings. Really important to a bond price, credit rating. All bond investors worry about two things. Can the issuer afford to pay interest payments? And can the issuer afford to pay the face value of the bond when the bond matures? Okay? And if you're an issuer, you worry about these things too. But if you're an investor, you really worry about these things. So there are private companies that issue a grade that reflects the ability of an issuer to pay interest and principal. And they are called credit rating agencies. That word agency is misleading. It makes it sound like it's a government entity, but it's not. They're private companies. The largest rating agencies out there are Standard & Poor's, Moody's, Morningstar, and Fitch. There are a couple of other companies out there that rate bonds, but these are the biggest, the best known, largest companies that rate bonds. All right, each company has its own rating code, but in general, AAA is the best rating, AA is the next best rating, and single A is the next best rating. BBB is next. Below BBB is not considered to be investment grade. A rating of D means the issuer has defaulted on a payment. Some rating companies use a plus or minus with their letter grade, so you might be A plus or A minus, double A plus or double A minus. All right, bond ratings can change after an initial grade or rating is issued. Rating changes are based on the financial condition of the issuer. These companies go through a very deep analysis. These rating agencies go through a very deep analysis. They use a lot of ratios and a lot of formulas to determine how a company is positioned to make their interest and principal payments. Rating changes can have a significant impact on the market price of a bond. Okay, so after a bond is rated and then issued, if the rating changes, then the price of the bond will go up or down depending on whether the rating is improved or if it's downgraded. All right. Issuers meet with the rating companies to make their case for a particular rating. So CFOs and CEOs will often meet with the rating agencies to discuss the rating, because the higher the rating, the lower their interest rate will be. The coupon rate of the bond is greatly affected by the initial rating assigned to a bond. So it can amount to millions of dollars over the life of a bond. So it's a really important issue for companies to go and get the best rating they can from the rating agencies. Please keep in mind that it is the issuer that pays for a rating. It is not the investor who pays for the rating. Some people think this is a conflict of interest. Okay? This was a problem leading up to the financial crisis of 2008. Rating companies were earning enormous sums by rating mortgage-backed bonds, and the rating companies either failed to understand the risk of these bonds, or they were unable to resist taking the big payments to assign fraudulently high ratings. So the conflict is, if you are issuing a bond, you want that bond to have a high rating. And if you go and pay for a rating, then the bond rating company might be tempted to give you a better rating if you slip them a little cashola. So that is a conflict of interest. Let's see how far this one goes. All right, there are four main risks of owning bonds. The first is credit risk. Credit risk is the risk that the issuer will be unable to pay interest or principal. Then you have interest rate risk. This is the risk that interest rates will increase, thereby forcing down the market price of a bond, so you could lose principal value. Then there's inflation risk, the risk that the rate of inflation accelerates. This would force interest rates overall up, and it would also mean that interest and principal payments that investors receive in the future would have less purchasing power. So these are risks that investors face. Okay? Lastly, liquidity risk. This is the risk that the lack of dealers or buyers and sellers would make it difficult in terms of time and or expense to transact in certain bonds. There are certain bonds that trade very frequently and you get a fair price for your bond. And there are other bonds that there are not a lot of bonds out there. There are not a lot of buyers and sellers out there. So if you want to buy a bond, you really have to pay up. And if you want to sell a bond, you're not going to get nearly as much. This is called liquidity risk. Then there's reinvestment risk. This is the risk that interest rates decline after a bond is purchased. This means investors will have to reinvest their periodic interest payments into securities that have lower yields. So you buy a bond, let's say it pays 9%, then rates go to 8%. That's good for the principal value because the price of your bond will go up. But if you hold on to that bond, every time you get a bond payment and you want to reinvest that bond payment, you will reinvest at a lower rate because interest rates have gone down. All right, that was a quick clip and we're going to stop it there. Shalom.